Hello, everyone, and welcome into crushthestreet.com. I got a hard-hitting interview for everyone today. We're going to be talking about the coronavirus, the stock market, precious metals, and before we get into that, I have a new special report that I want everyone to be aware of. It's going to have a lot of up-to-date information regarding the coronavirus, and if you want to get access to this report, visit crushthestreet.com/virus. And I'm actually going to have regular posts from the guest that I have on the line here today, who does regular updates on precious metals and the coronavirus. I'll be linking her articles in that report. So definitely check it out. But who I have on the line is someone very special. She goes by the moniker TraderStef. She writes and contributes here at crushthestreet.com. So it's a real special treat. She's one of the most respected analysts in the precious metal community, and she's been covering the coronavirus like really nobody else I've seen on the internet. She's a former Wall Street insider. She began her career in 1996, spanning 14 years with a New York City investment banking industry, diverse skill sets in human resourcing, technology, communications, training, education, development, business analyst, and global risk management. She's been following the precious metals markets. She's now here with us at Crush the Street. Her bio goes on and on. She'll be such a breath of fresh air for everyone here today. And so without any further ado, let's welcome TraderStef here to crushthestreet.com.
Ken, how are you? It's good to be back on the video.
Oh my goodness. Well, I'm excited to be doing this interview, and I feel like it's very, very timely. Our interviews have been timely in the past, but this one is especially timely as we are seeing lots of volatility in the markets and a lot of uncertainty as it surrounds the coronavirus. And so you've covered this extensively with the articles that you write for us at Crush the Street. And so let's start off right here. How serious is the coronavirus? And can we compare it to anything such as SARS, H1N1, swine flu, the Spanish flu? I mean, is it comparable to any of these other illnesses? And, how big of a deal is this?
Well, I'll first say it's great to be working from home. It's never been better, where you don't have a job where you have to commute and be around a lot of people. So being able to work from home is a blessing in disguise. But this isn't in no way, shape, or form designed to be fear porn, because it's real. We have a pandemic going on. And just a couple of things before we dive into the history of how this got started and where it's at. Look, there's no vaccination. There won't be for 12 to 18 months. And then even then, by that time, it mutates. Just think of the seasonal flu shot. There's no cure, and there are no therapeutics available. Like if you go for over-the-counter medications to reduce your symptoms, there's nothing that's been approved. They're running some tests with some patients over in China and whatnot, but there's nothing out there that can really help you except protecting yourself and being aware of your environment, keeping your hands clean, keep your fingers off your face, keep your fingers out of your eyes, keep your fingers out of your mouth. Just
so no Tamiflu, no NyQuil, things like that. It's not going to help you.
You need to pay attention to what you're doing. So it does not discriminate. And if you have an underlying health condition, especially if you got a compromised immune system because of medications or you had some previous superbug infection or otherwise, it'll put you at a much higher risk. And the important thing to remember about this, there's a thing called viral load. And that varies from patient to patient. In other words, how much virus is actually in you transfers into how much you're spreading around. So that can lead to super spreaders. And if they are asymptomatic and have a big load, that's even a bigger problem. And now there's two strains running around. One other thing that's important is the single-digit fatality rates they're giving out are actually not accurate. And how that math is done, what you take is the recovered released deaths, not the total confirmed, but people who actually went in and left the hospital, or they left the hospital on a stretcher. And then you take the amount of deaths and you divide that, and that gives you what the fatality rate is. So look, even this morning, the WHO was saying that the rate is much higher than they thought. And this is crazy, but we have the socialists in the political spheres, the one out in Denver, where she's on one of the city's committees, she's telling people, if you get sick, you need to go to Trump rallies and pass around the virus. I kid you not. It's main headline news. So that's kind of scary. And let me throw one quote out there from David B. Collum, if anyone's familiar with him. But the other day he wrote this. I found it very prescient. He says, everybody is canceling everything. Flights, meetings, conferences. Nobody wants to be the chump that held the meeting at death. The global economy and supply chains are breaking down at breathtaking speeds, in my humble opinion. So look, back on January 21st, I started writing about this, and it kind of took over. I never really expected for it to, turn into what it's turned into. But if you don't follow Dr. Henry Nyman, he's a virologist. He's been doing it for 40 plus years. And his website is recombinomics.co. And he's been documenting this outbreak since early January. Now, when you think of a virologist, he's the guy that's in the big meeting who's waiting for everyone else to catch up. Now, he's responsible for having contacted the team in China back during the SARS outbreak in 2002 and 3, because he identified the mutations that were going on, which led to a white paper and led to a lot of things to help pat that virus down and kind of put it to bed. And this new one, when they finally got the sequences, the genome sequences, which wasn't until late December, January in the United States, he identified out of 41,000 coronaviruses that are currently in the gene bank, when you do a search, within 20 seconds, there were 2 strains that popped up. And those were the same 2 strains that were back from SARS in 2002 and 2003. So then on January 29th, I put out another article, and we began to realize that there was no way to contain this spread of the infection, because it had already seeded through multiple locations around the world. And people were infected like 2 to 3 weeks prior were finally being observed and being confirmed. And airport temperature screening is ineffective, because of incubation periods and the asymptomatic phenomena. Or you have people taking over-the-counter meds to help relieve symptoms of what they thought was just like a cold or a flu. And like 5 million people left Wuhan during the Lunar New Year, which China was celebrating. Some of them left because they were going on the holiday, but some left because most people in the metropolitan area in Wuhan knew what was going on by late December. So they were like getting out of town for whatever reason. And then the Lancet, the medical journal, realized that in Washington and Illinois, which Dr. Nyman picked this up, there were these 2 mutations in the current genome from the original cases. And I don't want to get too technical here because we'll get lost. It's called an ORF8 and a 29 nucleoid deletion. And, that kind of like equals, goes to super spreaders. But then it's got a 3rd deletion, which brings us into the current time frame. So Seattle has suddenly made the news over the past couple of days. And as it turns out, it's been spreading for like 6 weeks, right? So the first patient several weeks ago had a travel history from China. He was symptomatic right around the time he landed in the United States, but he thought he had a cold or a flu, and then he saw the news, and then he finally went to the doctor 5 days later. And his genome sequence had the ORF8 and the 29 nucleoid deletion and the 3rd mutation. So that was the match. Coincidentally, everyone in Seattle was having this coughing thing going on. So the local labs in the state of Washington started doing testing for local flu. And they subsequently expanded to COVID-19, not something clinical, but kind of like experimental testing, because they had no certification this is important, for the PCR test for the COVID-19, if the patient did not meet like specific requirements at the time regarding COVID, such as you had to have traveled to China. So what's a PCR test? It's been around since the 70s. It's what they use to check for the flu, HIV, retroviruses, and it can identify COVID-19, but only as a presumptive case. And then it goes to the CDC to be confirmed. Now, the most recent patient was a 17-year-old high school student. He had not traveled, and he tested negative for the flu, and it turned out he was a human-to-human transmission case, which included onward progression and then a sustained community outbreak, which is what the CDC and the Fed were waiting for to take additional actions. And his sequence showed the same 3 mutations from that first patient 6 weeks earlier in Seattle, which was proof that the virus had been running around loose for 6 weeks. Now, keep in mind, test kits were sent out, and each kit includes 700 tests. And they were sent out by the CDC, but that third mutation, otherwise known as the negative control, just to make sure you're not picking up anything that's positive rather than, the COVID, it wasn't working right. So the CDC had to recall those kits and fix them. So the actual kits for the COVID have not been in use since early last week. So if you put together the fact that you got the flu study in Seattle, and then the COVID-19 match in Seattle, most recently, the 17-year-old kid, people have been running around passing this on. And then you got all the people mixed in who may have traveled to Europe, China, Italy, Iran, pick your country. So we got all these schools closing in Seattle. We've got the long-term care facility with all the elderly patients, 108 residents, 180 staff, 52 are symptomatic, and 4 of those 6 deaths have been confirmed as COVID-19 at this point. And now all the first responders that went there to take care of them, they're all quarantined. So I did an additional article called The Harvester of Sorrow and the First Wave of SARS and the 2.0 novel coronavirus, and how that relates to the flu pandemic, which goes back to your question. Is this like anything that we had before? Yeah, it's like the 1918 flu. Back then, cities that didn't allow large gatherings, they fared a lot better and had fewer infections. And just for the record, my grandmother was orphaned because of the 1918 flu. If she had passed away, I probably wouldn't be here today. And her mother passed away, giving birth to the 6th child, which was very common if you were giving birth. And then her surviving father and the newborn died soon thereafter because of the flu. Now that flu, it's known as the Spanish flu, which it didn't originate in Spain, but it kind of stuck. But it originated from China because China was having a major flu outbreak, and the United Kingdom and the United States were taking laborers from China, transporting them through North America over to Europe in order to dig trenches for the war, because they needed their young kids in the West to fight the war. So that was their labor. And these folks brought over that virus and seeded in the North, American basin, basically. So this new virus, if you haven't seen it, I'm going to throw up a little picture here so everyone can see it. Can you see that, Ken?
There it is. Yeah.
So those things that are around the virus, they're called crowns. And on a typical virus, they have to connect to a cell. And the typical ones only meet 1 or 2 amino acids, and this gets complicated. But in other words, the virus needs to communicate with the human cell. This one's got a lot more attachments on it, so it can get into more cells. When I say that, I mean it's not just getting into the respiratory tract and your nose and your throat, but it can get into your intestines. It's showing up in fecal matter. And also you've got these cases, I'm sure you've heard of this, where people are suddenly dying on the street in China because it goes into the heart. the virus goes into the heart and it creates something called myocarditis, which is not something new. It's something that's medically known that goes on with patients that have a viral infection. And then you basically have a sudden cardiac arrest. And that will include, like, you go into, you start spazzing out when you're laying on the ground. So there's a lot of things about this virus. It's definitely happening. It's not a conspiracy theory. It didn't come from a lab. And Nyman has pointed this out. We're talking about evolution. And viruses are really, really smart. And once they get into a host, then it begins to mutate. And that's what we've seen right now.
Steph, let me jump in right there. If I can be devil's advocate or just use, some surface level logic on this, is it possible that the milder symptoms are being underreported? Those that may have it, that get it and it goes away, and they're not being counted. So it's almost like the flip side to the mortality rate. They're only counting the people that they know that got it, but maybe there's a lot of people that are getting it and then getting better from it, and then they're not really getting counted either, which would also lower the mortality rate.
Absolutely. There's two different strains going on, and the worst strain, about 16% of the patients actually develop pneumonia. But back to the Seattle issue, they started doing flu tests because they had this coughing thing going on in Seattle. So the state took it upon itself to do PCR tests for the flu. But you could even come up negative because it was a mild case of the flu. But beknownst to them, some of them were COVID-19 cases, like they found out with this 17-year-old high school student, which now they're being allowed by the CDC to test for the COVID, even if they don't match specific criteria like travel to China. So, just like any cold or any flu, the symptoms vary. And like I said at the beginning, there's a thing called viral load. Depending on how much virus is in you, determines how much you're spreading and how sick you actually are. And then you have to take into consideration your level of health and where you are. And just one thing that might freak people out, but since this virus is getting into the intestines, for instance, and it's getting into fecal matter, if you're using a public restroom and you flush the toilet, you don't want to be standing on a toilet or let the spray from the toilet go up and spray on your skin. Nor do you want to use a public sink and let that water in the sink splash up at you, because you don't know who's been using those restrooms before you.
Steph, let's talk a little bit about the economic grind that this could mean for the economy. If we have travel shutting down, schools shutting down, even if it's not as bad as we might think it is, just the fear alone. I went to go get some additional emergency supplies, and I'm seeing the store shelves pretty bare. If you're worried about having some extra toilet paper, if you're worried about, having some extra beans, rice, things like that, Cliff bars and granola bars and nuts. You need to go now, because the shelves are starting to get cleaned out. But in addition to that, what's the cascading of events that could potentially happen if this continues to go on, which it certainly seems like this will be the case?
It's really kind of hard to speculate on how bad it's going to be, but we're definitely in the pandemic phase, number one. Now that we're in the modern age, we got airplanes, buses, trains. This thing primarily spread through airplanes. When we were talking the Spanish flu, we had ships crossing the Atlantic and local spread. But in the modern age, this thing is spreading really fast, and it's already seeded. So any discussion about whether it's going to be in your community or not is water under the bridge. It's probably already there. It's just that the testing was not being done, and it's been circulating through communities for weeks. So now we're just beginning to see confirmed cases that they were infected a long time ago. So there's going to be this cascade effect where the numbers are just going to explode for a little bit, and then they're going to kind of taper off. And with regards to supply chains, yeah, that's important. And I got a picture up there. And it was 4 weeks ago. After I did that first article on January 21st, I went and I started getting some basic supplies. That wasn't being, that was being overly cautious. Just picking up the basic stuff that you would use anyway. And some of the first things that will run out are things like toilet paper, paper towels, those things that you use every day on a daily basis that you're going to use anyway. So, you know, worst case scenario, you have what you need. You don't have to panic with everybody else, which is what you're seeing in New York and California now. That picture's at a Costco's. And yeah, I would suggest that you go out and get a few weeks of supplies, because there could be, just like you have blackouts with power and they can travel from county to county depending on what the situation is, there could be rolling quarantines that would be very local. You know, you get one teacher that confirms positive or one student that confirms positive, which is occurring now in Seattle. They start shutting down the schools. And if you work and you have children and now suddenly your children at home, that completely blows out your schedule as far as how you took care of things. So there's a lot to consider, and it's very important to be aware of what's going on, but don't panic. Just prepare for the basics, be aware of your surroundings, keep your fingers out of your mouth.
Steph, any indication that warmer weather is going to put a little cap on the spread of this disease as we go into April and May?
Well, yeah, the physician who's in charge of infectious diseases at Johns Hopkins, he actually pointed that out like 3 weeks ago. And he said, look, this thing has seeded in the country, and now it's going to be a seasonal issue. So it'll be just like the flu. It'll pop up in the fall. But being that we're in the first wave of this new virus and it's mutating through the hosts, it's getting much more efficient. The second wave is going to be, it's going to come back with a vengeance in the fall next year. So, you know, it's here permanently, and that's my concern. I think people may get a little complacent in the summer. And as far as how long the virus lives, when you're talking the warm weather, I mean, there's cases popping up down in Brazil and South America now. So just because you're in the summer months doesn't necessarily mean that it's not going to happen. But one thing that does help is that, remember, when you got more sunshine, this thing won't live on a surface if it's being hit by sunshine because of ultraviolet light. So in a lot of ways, it'll tamper down the spread. But as far as human to human transmission, someone sneezes and you're in a cool, dry place or in a building, that kind of thing's still not going to stop, and you will still need to be aware. But it will pick up again as we get into the fall.
Steph, again, comparing this to previous pandemics, just most recently SARS, H1N1, you know, we saw the Fed react in an emergency fashion. I mean, we didn't really see the stock markets, global stock markets, react to SARS and H1N1 the way we are seeing it happen now. You know, obviously the Fed 0.5 point rate cut on the coronavirus and the global economic concerns. What does that say about how significant this virus is compared to the other viruses? And, you know, what are your thoughts on this?
Well, remember, the CDC and the Fed and the WHO were waiting for confirmed onward progression and community infection and progression, which now we have. So that's the confirmation that we're in a pandemic. Plus, we've got all this delayed issues going on with the testing, and people who are popping up positive were positive for a while and they've been spreading it. So the Fed finally pulled the trigger, and it was over the weekend where they had a meeting with the G7, and it's a coordinated response. And that 0.5 point was the first time the Fed cut in between meetings since 2008. So look, back on February 16th, when I wrote an article, I said that any hint that the coronavirus was reaching an epidemic proportion on US soil, it would probably force the Fed's hand to pursue a more aggressive repo and or quantitative easing scenario, which would push real interest rates below zero and, deter capital flows. And here we are. The interest rate on the 10-year Treasury note, we broke 1% yesterday. That was historic. So when you take inflation figured into that, we're in real negative interest rate territory. So it's just huge. And that is just going to force more safe haven flows into safe haven assets. So you want to go right into the Dow and the S&P charts and see what they did?
Absolutely. I mean, it was very significant. I mean, we had that big, massive 4,000 point drop. We saw that pretty significant rebound. But then it was odd, right? We had that half a point cut, and it was initially positive. And then we saw those gains wash away, which really leads me to believe that the Fed is exhausting itself in this environment. And here we have, I'm seeing this headline on investing.com today as we do this interview on March 4th, 2020. The headline is, the stock market surges as Biden wins, and does well in Super Tuesday. I'm paraphrasing the headline, but, they're attributing the stock market rise to the diminishing chances of a Sanders presidency, basically. But anyways, let's definitely get into the charts and your thoughts on what we're seeing with volatility in this current environment.
Sure. Just a quick look at that 10-year Treasury note chart going back to 1980. You can see the bond market has been in a bull market. I mean, the chart's going down, so that can confuse people. But since the rates are going down, that's a bull. If you're invested in a bond income fund, not actually purchasing bonds per se, you're doing very well right now because it's the safe haven play. Everyone wants to run into something that they perceive as being a safe haven. So there's more demand, the interest rate's falling, and you can see what happened here. And when we got into 2014, 15, and finally last year, we confirmed a pattern here, which is a big M. And then we had a neckline. Well, I don't want to say neckline, but a lateral. And we began to break through that. And let me just zoom in here so you can actually see it. So we're still in that down channel, and we've clearly, decisively broken through that lateral spot. And that price that we're looking at, it says 9.68. So we're below 1%, each one of those points. So if it was 16, that would be, 1.6 interest rate. So we're below 1% again this morning. We're just in historic territory. And when you look at these indicators down here at the bottom, we're kind of like oversold somewhat. But the other one's telling me that we got a bit more to go here. The rates are going to go lower. And we've got this little trend line that I threw in right here where that red arrow is pointing to. I think we're going to end up at minimum down here. And we're looking like at a half a point. And there's a possibility that we'll go below zero, and wherever this line, the bottom of this trend line channel will take us to. And, we're talking a half a point below zero. So we are in real negative interest rate territory if you factor in inflation. And we're floating just above zero interest rate policy. So if we look at what happened on the stock market, let's go take a look at the Dow. Let me fix this up for you. Just give me a moment. It's the weekly chart. All right. So I know it looks kind of busy, but just take a moment and just stare at this. So that's the Dow Jones. It's the weekly chart. Goes back to 2018. Had a nice pattern there. You can see the inverse head and shoulders where those three Here's a left shoulder, a head, and a right shoulder, and there's your neckline. We broke through it, made all-time highs. At that point, I snapped some Fibonacci lines because I wanted, they're called extensions when you're going into the future, because there's no history to judge where the resistance or the support would be. So the fibs give you an idea. And as you can see, every time we hit one of those extensions, it would settle and it would chop, and then it went up through it. And the high actually hit the 38.2 and stopped. And then we began to roll over. So remember, we're looking at a weekly chart here. So we had this nice up channel. We broke through the all-time high through that neckline. And there's the big plunge last week. And notice, now we're back into different Fibonacci levels. So forget the extensions that went beyond that first all-time high. Let's just look at the fibs from this low in 2018, December, and then to the high that we just made. And you snap them, we came right down and we tapped the 61 on the button. It also matches with one of the lows put in back in 2019. And just for the record, right here is where the Fed began their repo operation. And then we got the run. Let's go to the SPY. It almost looks identical at first glance. And it basically is. It's just the candles are a little bit different and the numbers are different. So right now, this thing, with the Fed cutting interest rates, it was interesting because when they cut the rates yesterday, the market plunged, right? Gold went up. It's weird how that works. It was almost like buy the rumor, sell the news, because once they really had to cut, that's telling everybody, you would think it would be, oh, well, the Fed's got our back, so boom, let's go into the stock market, everything's good. Well, the reverse psychology came into play. It was, wow, it's actually really bad. They're probably going to do more. That's why the market sold off. And if I flip into the daily chart, just to, you can see what it did on that daily. You know, it really, we're looking at the S&P on the daily. Really, you know, those falls, those candles are big. But if you want to talk about history, and if we just look at the Dow just for a moment, when we go pull up the data on the Dow, because percent is more important than points. Just keep that in mind. So when we look at the average 6 to 8% declines, going back to 1896, last week was 47 on the list. Doesn't mean that that wasn't a big deal, what happened, but you know, it was 47 on the list. And if we go to the single days, the big day that the fall we had last week, it's 64 on the list when you go back to 1896.
Steph, so to kind of summarize those charts, what is the biggest takeaway from this? Should we expect more ongoing sell-off? And is it going to be because of the coronavirus? Or, like Peter Schiff has pointed out time and time again, this is an overall everything bubble, and the coronavirus is the pin that's bursting it, and you know it's doing what it's going to do. Or is there some sort of in between point on the spectrum where it's just a combination of overbought equities, dealing with the coronavirus, and trying to traverse this? What are your thoughts?
Back on January 31st, I wrote about that, and I'm not going to change what I said back on January 31st because it applies. And I said that my expectation for the price going forward in the down S&P is that it would be more bearish with further losses on the table. And there will be extreme bouts of extreme volatility, and that both indices are ripe for more downside. And the scalping opportunities by seasoned traders, whether it be intraday upside or downside moves, is for the seasoned professionals. And that back in January, it was a good time for the passive investor. Let's say you have a money, like you have a 401k and you're just doing your automatic contributions because you're getting a match, and that's all good. But if you have any account like that, you always have the money market cash account where money transfers. And I suggested that it was a good time to take the most vulnerable investments in your portfolio and move them over to cash and wait, and conserve your capital gains and wait for the correction to prove a bottom. Now, beknownst to me, I mean, January 31st, I knew that the coronavirus was beginning to pick up and it was going to affect the markets at some point. But there was a specific day where we kind of hit peak coronavirus fear. And I stand there. I think we're going to go lower no matter what the Fed does for a while. And this is going to take a while to shake out. And at the same time, I could be completely wrong. We could wake up tomorrow and everything's beautiful. And there are no problems and there's no debt, but I think that's highly unlikely. I think it's going to be choppy for a while before this thing figures out what it's going to do. And maybe we'll get some more gains in the summertime. Not necessarily all-time highs, though.
Steph, I don't know if you want to get into gold and silver now, or should we go into Judy Shelton? I know you had some thoughts on her nomination and her symbolic presence as a sound money figure in the Federal Reserve Board. So, what is your, which way do you want to take this? You want to go into precious metals, or you want to go into Judy Shelton?
Well, she's a quick mention. She won't take a couple minutes. Well, she was nominated to the Federal Reserve Board like a month and a half ago or so. If anyone's, forget what you're hearing in the headlines. Don't parrot what you're hearing out there, particularly from the mainstream media. Go to the Cato Institute, and that's spelled CATO, and do a search on their website for this title, The Case for a New International Monetary System. And she penned that in April of 2018. So it's The Case for a New International Monetary System. So they've connected her with Trump, but she's been around for a long time and she's had those views for a very long time. But she ended up being an advisor on the Trump campaign during his election back in 2016, which led to her being nominated to the Fed. So that day that I was watching that initial hearing, I mean, let me put it this way, the ignorance of some of the politicos on monetary policy, in a historical context, and the disrespect for her as they kept interrupting her in the middle of her answers that required to explain an intricate relationship between the Fed, their policy, Congress, and where the world is now. It was just really appalling. It was really horrible. But with that said, despite how bad it was, and we knew it was coming because of her views, and they're not extreme by any stretch of the imagination. She's looking for a middle ground that's very clear in her article at the Cato Institute. So now in the background, Politico actually just published something. It was on the 27th of February. And, they have these behind closed door sessions now where they're trying to hash it out, how they really feel about her. And she gets more questions and answers that are not in the public forum. And it looks like it's working out. She'll probably get nominated. So that would be a good thing because it's about sound money. And that's what we need. I think everyone's focusing, when it comes to gold and silver particularly, focusing on the price action and the paper markets and what it does or doesn't do is really not solving the problem for average Joe and Jane with regards to your money and sound money and what it's worth. And what you're seeing, I think there are about a dozen states now, and Alabama just put out a note yesterday. They got a bill in their local legislature where now you'll be able to use gold and silver as money and it won't be taxed. Because your dollars aren't taxed when you're buying something. You may be paying local sales tax, for instance, or your income tax, but you're not being taxed on your actual money. And that's what's occurring with gold and silver when you buy and you sell it at certain amounts. That's going to eliminate gold and silver being taxed in transactions. and it'll be sound money and legal tender. That will do more for the price of gold and silver and returning to constitutional sound money than any court case or worrying about spoofing or anything else that's going on. That's what we need. Sound money, Judy Shelton, supporter. It's my humble opinion.
That would be a breath of fresh air, considering we know that there's not that many sound money advocates in leadership. Steph, you've been pretty spot on when it comes to the moves that we can expect in precious metals. You've made the case through interviews and articles why 1620 to 1697 air gap existed and why we went right through that 1611 number without much hesitation at all. And we saw that pullback around the 1697 level in gold. And last Friday, I want to point this out, the markets were panicking. The overall equities were getting sold off. The baby was getting thrown out with the bathwater, so to speak. And, you know, we didn't exactly see gold respond in safe haven, in like a safe haven way. I mean, it was selling off significantly at the same time as the stock market. So I'd like to get your thoughts on that and also comment on gold as a safe haven. Is it something that will play out over the longer term, despite maybe, you know, how it might trade on any one specific day? Or could we expect gold to go to 1,200 or 1,000 if we did see a massive correction in overall equities?
Yeah, gold's definitely in its safe haven role. I'm going to bring up the charts here in a moment. But it was back in December in interviews and articles where I was pointing out, as you mentioned, the 1620, 1697 area, which goes back to areas in 2013 as it was chopping down before the fall. But we had to take out 1611. And at that time, on a weekly basis, we weren't closing above 1611. We just kept hitting it. It was like 4 or 5 weeks. Don't hold me to that number. We'll see it on the chart. And then finally, when it took it out like a knife through butter. And that was when we hit peak coronavirus news, right? And it spiked up to 1690 in within 3 days. But then it fell just as hard, you know, the next day. So look, nobody was complaining as gold was spiking and moving, but the moment that it takes a fall, you know, everyone's worried. It's like you just can't have it both ways. And the reason for it going up and down were for the same reasons that occurred before. So look, that sudden and overbought sweet spot, which you call a Momo play, it's now water under the bridge. Okay, and you know, the music stopped playing in the markets way back in February, around the 13th. All sectors of finance and industry suffered from a tremendous plunge last week. And the precious metals were really no exception, but there's some reasons for that. I talked about that in an article on silver on February 27th. It's called "A Deep Impact is Blunting Silver's Upside Potential." And not all of these apply to gold, but they all do except for one. The one that doesn't affect gold so much is that the base metals were being sold off too as commodities. And that was because of expectations that there was a global economic slowdown because of, you know, China pretty much being shut down. And they're like 30% of the world's GDP, for God's sakes. Then if we take in other things into consideration, which is probably the most important one out of all of them. And let me bring up this chart to just give everyone a reminder of what happened back during the great financial crisis. All right. So there was some profit taking because of that spike that we had last week. But because of the market, look, it's unprecedented how the Dow was selling off at 1,000 points on a daily basis in such a compressed time period, you know? So there was margin calls going on. If anyone that doesn't understand what margin calls, I think most of your listeners across the street know what a margin call is. You're borrowing money for the house. The big pockets tend to do that more. If you're going bankrupt and you're underwater, you get the phone call. It's a margin call. It's like, hey, we need some collateral to cover this mess that you got yourself into, because those moves happen really quick. One of the first assets big money goes to is gold. Now, I'm not saying they're running down to the vault, down the basement, getting a bar of gold and selling it. No, they're selling the paper. So actually, no real gold actually got sold. It was all paper, contracts, spot price. Same thing happened if you look at this chart during the financial crisis. Gold was spiking as the Dow was plunging in 2007. Then the margin calls came in when the Dow was getting hit really bad. And there was a point in time there where finally the margin calls were all met. Things weren't as bad as they were, but the Dow kept plunging. Like 3,000 more points, but gold started spiking again. So when all was said and done, gold was up 286 bucks from beginning to end.
Right.
Dow was down 7,728 points. So what has that got to do with right now? Well, by the end of February, the options and expirations and settlements were taking place too. So all this coalesced into 1 week. It was like a perfect storm. And the fund managers were locking in their gains for the end of the month performance. And then you had more selling, and then the forced margin calls and assets across the board, not just gold, silver. And then here's probably more important than any of that, automated trading platforms with high frequency trading algorithms accelerated the efficient scalping of equities, and artificial intelligence with machine learning robots finally established their new vocabulary for what the word pandemic means. Or super spreader, for instance. So look, welcome to the machine. I've been kind of repeating that on Twitter quite often. And one quote I want to bring up about artificial intelligence, it trends towards psychopathy when it gets optimized. And this was an example. And that plunge in the Dow is just an example. So if we look at the current gold chart, pull that up for everyone. So this is the chart that was in the article, my most recent gold article on the 29th of February, and it's the monthly. I know it's busy, but I want to zoom in and show you an easier chart to look at. But just for the big picture, you can see where it was, where we've been. So notice that before the financial crisis, here's the financial crisis right here. And there was your fall, and the margin calls took place here. But this whole point here from the low in 99, right around 300 bucks, this was the primary bull phase. Once we got out of this, this was the secular bull. And some people consider this whole thing the secular bull. But no matter, there's always this phase of accumulation that takes place. And when you look over here on the right of where we've been with gold recently, once we took out, well, actually when we pivoted in 2015, in hindsight, when we put in a higher low, we realized that we were probably beginning the primary bull market phase. And accumulation was taking place. And then what came into play was this 1380, which is a Fibonacci number. That's when you take the all-time high down to what the low was. Finally, when we took that out, took it out by butter, and that was for a different reason. You know, sometimes the news just happens so fast and it's so old I can't keep track of all of it. But if we zoom in here to it, and let's just look at the daily. Right about there. That goes back a little bit further, but right here is at 1380. Got a flag tilt pattern, then had a falling wedge, cup and handle. This is not a pennant. That's a symmetrical triangle. And then we broke through it, And right around here, I was like, hey, 1611, keep your eye on 1611. Now, there's something else going on here on the charts I don't think a lot of folks are picking up. If you watch charts, you see it. But look at that break through that 1611 right here. It had the momentum behind it. The buy volume down here began to fall off. What you always want is, when the price is going up, you want the buy volume to go up too. If the buy volume is going down while the price is going up, well, you know you're getting close to some kind of correction. Well, on that day, that was one day actually that we went through that whole, it's not specifically a gap because there's price action, but it's back to 2013. But we filled that 1620 to 1697 in one day, and it put in a plunger candle. So remember, this is the daily chart. We knew this at the end of that day that that was a plunger candle, and that tells you there's going to be a correction, more than likely. It's not 100% accurate, but it's the heads up. You need to pay attention. Well, the next day we had a fallback, then we had some chop, and then I think this was last Friday, the 28th. Yeah, that was the big fall. But take note that we have not, let me zoom out, and we're going to end this on gold. There's an up channel here that we are solidly in the middle. We're not breaking down below it. We're not breaking out above it. We're right in it. It's moving well. This is a bull market. Nothing has changed. Matter of fact, it's more bullish now than it was a few days ago. What you want is breathing, and any asset goes up too fast, too quick, it's going to fall harder. Just like we saw taking out that whole gap, for instance. So we want some consolidation. We need to have some patience and some time here for it to move. But look, one last thing on this. Take a note of that volume down there. And that's all these bars down here. The buy volume, that the one day of sell volume was a record sell volume. But the buy volume on this, on these days, on this pullback, it's unprecedented. It's record territory. So this is extremely positive for gold. There's really nothing negative I have to say about it. And it's not because I'm invested in gold. It's just what the chart tells me, and the chart just doesn't lie.
Well, Jim Rickards would give you a hat tip as well. He quoted you, "We can sell gold to raise cash to meet stock market margin calls. The strong hands wait a bit, then they pounce."
Yeah.
So that was a nice mention from Jim Rickards.
You want to look at silver real quick? I know a lot of folks are silver bugs because it's a lower price point, right? You can buy more of it.
Absolutely. That's where I was going next. Let's definitely talk about this 2149 level regarding silver. Silver is at this 95-1 gold to silver ratio. I know, everyone's talking about how, that needs to go back to some sort of reversion, some sort of equilibrium, but it's almost like we're getting used to a new role that silver has in the precious metal sphere here. But, you've done a lot of analysis on silver, and I think we're all in agreement that the 2149 level will be a very significant point for silver, but I'll let you take it from here.
Yeah, I'm beating a dead horse sometimes, but that's okay. Folks.
No, definitely. I think a lot of people, this is going to be new information for a lot of people.
All right, good. Just look at the chart. Just stare at it. And notice that big red arrow. That was the first run off the big low from back at the turn of the century. And that was 2149. At that time, it wasn't a Fibonacci level. Okay, just to be clear. But 2149. Then it pulled back. Then it ran. But once it took out that 2149, take note. We're looking at a monthly chart here. Take note of the violence of those candles, those moves. You know, we were having $1 and $2 and $3 moves in a 24-hour, 48-hour period. I remember this. I remember every detail about that time. And gold was spiking too, you know, but gold spikes first. It gets its legs firm. It runs its primary bull. And then at some point, the monetary aspect of silver will kick in, and it forgets about its industrial demand, you know, that 50%, which is putting pressure on it right now, because with the global supply chains closing down and the GDP beginning to take a hit, particularly China, base metals were getting hit last week, and more than 50% of silver demand is that industrial use. So it's getting pressure from more than one area. It's like it's not even thinking about my monetary role right now. But back in 2010 and 11, silver spiked and made its all-time high before gold did. And that's just kind of how it works. It's weird, but you know, I don't know what to say. But we took out that 2149, we put in the high, we came down, and then we bounced. This was like, well, we kind of chopped a little bit sideways, but when it bounced right here, the first bounce, we were chopping in this 2149 area. It never got through it. It hit this 50-day moving average, which is always important. And it went on for months. You know, this is a monthly chart. It just would not get through it. So that means not only was that an important resistance to get through back in 2010, well, now fast forward 2013, we broke through it. Now it can't get back up through it. You know, resistance becomes support, support comes resistance scenario. That's what happened. Lo and behold, 2015, gold starts taking off. It just didn't have what it needed to get through that 2149. It hit 2113. It was close. It was disappointing. Everyone thought that it was going to take that out and gold was going to keep running at that time too. But once again, you know, a lot of things happened and it changed. But in hindsight, it worked out exactly the way it was supposed to. And it was more bullish for gold for it to do what it did when it did, because it got a chance to get a more solid base and consolidation under its belt. So now silver, yeah, it may look bad, it may look negative, but let me just zoom in here. If you notice, it's been chopping sideways in a flag pattern, a half staff, for almost 8 months. It's not breaking below it, it's not breaking above it. And now we got a trend line up top here from the 2113 down to the most recent high. So it's not bare. We haven't taken out these lows. That would be a problem. But we're staying in this pattern, which is very interesting. So, you know, I think that silver is going to have its day. It's going to shine. We're getting the bounce back this week. There's your weekly chart. It's positive. It's not as bullish as gold. But like I said, you know, I'm beating a dead horse. It's water under the bridge. It doesn't mean that you have to wait for 2149. If that's your thing, if silver is something you're interested in, it's not for everybody. But it doesn't mean the stackers and the people who want to build positions, whether it be paper or physical, and those positions have different timing. When you buy physical, might not be necessarily the same time that you're trading paper. It's two different worlds. But it is a good time to, you know, buy something at a lower price point. You know, you can't go wrong with that because it's just so low, it's ridiculous. That's pretty much all there is to say about silver.
What a treat. TraderStef, everyone, our very own TraderStef. If you want to see her work, check out crushthestreet.com. Also visit the report, crushthestreet.com/virus. I'll be making sure her coronavirus updates will be included at that report as well. But Steph, any closing thoughts that you would wish to mention here as we round out this interview? My goodness, what a hard-hitting interview. I hope as many people as possible have an opportunity to listen to this and to hear your research and, you know, what you've uncovered, especially regarding the coronavirus. And again, I actually, what you said about precious metals too, because I would agree with you. The 2149 level is just a point that we see as a takeoff point for silver. But that doesn't mean that arithmetically it's not better to be getting in now while it's significantly below that. So any closing thoughts there?
Yeah, I would also add about silver is that, just like when you get the lateral support and resistance, once we take out that level and don't get stuck on the penny, 2150 level is what we're talking about. It's probably going to go through it, then it's going to fall back and retest it and then pivot off of it. And that's like the real opportunity as far as trading it with paper. But yeah, it looks good. Be careful out there with the coronavirus. Just, don't panic. Don't be a germaphobe, but, be a temporary germaphobe for a while. Just protect yourself. I think my cat has something to say because she's been all over my desk. I apologize to everyone. She's been meowing in the background. I don't know what it is she wants to say, but just be careful. I think gold and silver are doing great. Gold's doing a lot better than silver. And the markets are just insane. We're going to see more volatility. And you have to be careful, and it would be a good time to put some capital on the side, lock in those profits, and wait for this to play out. Not in gold and silver necessarily, but you got a 401k going on or something. Just be careful and follow. I'm plugging Dr. Nyman. He's just been doing it for 40 some years. He's old school. He knows what he's talking about. He spends all day looking at these sequences, and he's not biased with regards to the financial markets, for instance. He's just looking at the pure science. So it's great information. And he's on Twitter. I think it's at H for Henry Nyman, Niman.
Good word, Steph. Thank you so much for coming on Crush the Street. We'll definitely do an update here in very short order, but we'll talk to you very soon. Thank you again.
Thanks for having me on, Ken. It's been great. Been a while, but awesome.